Well, the rand has lost significant ground against the US dollar. The looting and unrest has also had a devastating impact on the economy. At the beginning of June, our currency was trading at 13 rand and 75 cents. Matrix Fund Manager's economist Carmen Nel joins me now to discuss this. Thank you so much, Carmen, for your time. The rand weakening against the dollar, what does it mean for the consumer?
Well, I think at this stage it could mean higher prices for imported goods, but I think it's important to note that while it's weakened by about 5%, on the whole it's still much stronger than it was a year ago. If you recall last year, the rand was almost at 18 versus the dollar. So at this stage, certainly at Matrix, we don't think it necessarily means a lot of inflation yet, nor that the Reserve Bank will necessarily have to hike rates. So I think at this stage, the weakness has been global factors rather than local, without meaningful implications for the consumer yet.
Let's get deeper into some of those global and local impacts. I know in my intro I mentioned that, the looting and the unrest quite recently might have contributed to, its impact as well as, to the rand. They're losing its ground. But globally, what perspective are we looking at?
Well, it's interesting to note that while as the social unrest recently felt quite alarming and severe to us here in South Africa, if you compare the way the rand reacted versus other emerging markets, the weakness was actually extremely limited. So the rand's resilience was quite a surprise, and that could partly be attributed to the fact that commodity prices globally are still doing well. And we know South Africa is quite an intensive a commodity economy with lots of commodity exports, so that may have been a bit of a buffer for the currency in the context of the social unrest. Rather, I think it's the global factors that have dominated, certainly over the past month or so.
Yeah. And also with that being said, last week we saw the Reserve Bank, flagging that interest rate could stay, quite low for longer. Could this be adding on to the weakening rand?
I don't think yet. Certainly interest rate differentials, which is sort of what economists look at in trying to forecast currencies, do matter. But remember, the Fed's interest rates are basically at zero. So even though the SA Reserve Bank is at 3.5, it's still a reasonable buffer. I think that it was important that the Reserve Bank did look to the growth impact of the recent unrest over and above the level 4 lockdown, and therefore, not yet risking significant rand weakness. Obviously, if the rand were to weaken dramatically, and sort of in our minds at Matrix, it's probably to above 15 versus the dollar, then we might be able to start to talk about hikes coming forward. But at this stage, it does seem as if the Reserve Bank's reasonably comfortable with the rand in the context of still weak growth.
And this conversation, Carmen, I can almost just see those who are either trading or those with investments listening in with keen ear to this conversation. What would your advice be to them? Do they have any reason whatsoever to panic at this stage?
Oh, no, certainly no panic. The currencies move in the big scheme of things. So from a macro perspective, 5% in terms of the rand's usual volatility is actually quite limited. So in that sense, certainly no reason to panic. Also, I think it's important that from an institutional perspective, our Reserve Bank is very independent, very focused on keeping inflation contained. And the Reserve Bank will also signal often in its communications to the public that its primary focus is on low, stable inflation, because inflation tends to hurt the poor. So I think that's very important, is that part of the rand's anchor is that we have a Reserve Bank that's very independent and very highly regarded in international markets.
All right, well, that's good news, of course, for investors and traders. Thank you so much for talking to us, economist and macro strategist Carmen Nel.